Good morning, everyone, and thank you for the organisers, Globebook, for inviting me to speak here today in Moscow. As Nikita said, my name is Paolo Farina, and I am the lead technical consultant at Nexant in charge of our world gas model. Today I'm going to be presenting some of my recent analysis around benchmarking country-level sources of natural gas feedstock, wryly summarised as where should I build my next plant, which is a question I'm sure we've all asked ourselves at least once. So why do this analysis in the first place? Well, first of all, it's fun, at least for me, to see how gas-centric areas rate against each other and how they evolve over time. However, these results and conclusions also provide valuable insights to investors and a powerful guide towards making investment decisions. The analysis itself differentiates on a country-by-country basis and looks at the current and prospective supply of natural gas alongside its pricing. When we take into account that feedstock pricing is one of the key drivers in plant competitiveness, we can then get a good idea of where the most cost-effective regions will be for gas monetization projects. Furthermore, it's also important to consider the security of supply, feedstock supply, especially throughout the lifetime of the project, and in particularly, at the very least, the debt repayment period. And this analysis brings that dimension into the work that I did. And finally, the prices that were developed as part of this study also can be used in complementary analyses, such as comparative economics, and I will touch upon this towards the end of my presentation. But before that, I want to give a quick summary in terms of where the global gas market and the global gas picture is and will be in the coming sort of 21 years. This is a pretty information-heavy slide, so I'm going to guide us through it relatively quickly. So the areas coloured in blue are all the regions that we expect gas to be either produced, consumed, or through which it will transit. And this is up to the forecast horizon, which is 2040 in this case. The green and the blue bars show consumption for the respective years 2018 and 2035. And similarly, the arrows show trade flows and directional flows as well. So what does this slide tell us? It tells us that gas has become an incredibly global commodity and that this trend of further globalization is set to almost guaranteed to continue. Consumption will grow by a third between 2018 and 2040, and Asia-Pacific will deliver about 50% of this growth. The Middle East and Africa are also regions of significant growth. However, the world isn't growing uniformly, and places like the CIS and South America have more of a reduced sort of potential for growth and consumption. And then when we come to North America and Europe, we're actually seeing stagnation and decline. In North America, it's to do with saturation of the market and efficiency, which is attenuating growth. And in Europe, it's the significant invasion and penetration of renewables into the energy markets. Nevertheless, global volumes of gas that are being traded are increasing at 3.1% year on year, which is a lot more than the increase in consumption, which is about 1.3% compound average growth rate. And as you can see by the number of green arrows versus the blue, there's many more trade flows that are coming online throughout the forecast. And this shows the sort of the shifting centres of gas supply, dwindling production in incumbent demand areas, and the emergence of new gas consumers. But essentially, the take-home message from this slide is that gas is going to become more and more available. Its consumption is going to be far more widespread, and essentially the consequence of this is there are going to be increasing opportunities for gas monetization projects. So how do we go about benchmarking all these existing and potential opportunities? Well, behind me you can see the scope of my study. We looked at 28 existing feedstock markets, and we also analysed 7 potential future ones. Those are the ones in the light green. Our methodology combined looking at feedstock pricing and assessing supply availability. Now, if I talk about prices first, due to the large variation of feedstock pricing mechanisms, developing the pricing wasn't as straightforward as just using supply-demand constraints, assessing competing fuel values, and looking at market tightness. From unregulated free markets, where spot prices are the norm, to contract prices linked to oil in countries which are dependent on imports, to regions where governments essentially set the price, we had to use various different forecast methodologies to develop our price sets. And as mentioned previously, it's also crucial for new projects to look at the stability of supply for cheap available gas. And so capturing this variable was very important to us, and so we looked at 2 different components. We looked at the supply surplus in each feedstock country, and we also looked at the growth in consumption versus the growth in production for all 35 countries. And the rationale for this is that big exporting countries with a lot of surplus gas will be more likely to have feedstock available for projects, and also in markets where production is outstripping the growth of consumption will also have new opportunities for new entrants into the market. We took all the countries and ranked them accordingly to each component, giving them a score in ascending order. And when these 2 scores were combined, given an equal weighting, we got a relative supply index value for each country in each snapshot year. But basically, the higher the score, the more viable a new investment opportunity should be. How do we present these results? Well, I'm presenting them on a matrix very similar to the one behind me. Simply put, the lower you are and the further to the right you are, the better it is, the opportunity should be. Conversely, the countries in the top left corner will find it more challenging to be competitive and attract investment for new gas monetization projects. So how well does everyone know their flags? I'm only joking. And congratulations, though. I was going to use a pointer, but I was thwarted by the LCD screen. But if you correctly identified Poland, the red-white flags, Poland as the top one and Indonesia, well then, congratulations. So plotted here are the 28 existing feedstock markets, based on the explained criteria. The orange rectangle at the bottom includes all those countries where the long-term supply score is above 1.8 and the price is below the median price, which in 2018 was $4.23 per MMBTU. And these are constant 2018 dollars. Bangladesh, Pakistan, and Bahrain at first sight, to sort of the left, bottom left of the graph, seem to have low prices. So on paper, these are great places to go and build a project, isn't it? Well, when you factor in the supply dimension, it turns out they've got very poor supply prospects, and therefore we would discount them from any benchmarking study or screening study when looking at potential places to look at for investment. The countries in the top left with poor supply prospects and high prices tend to be countries that rely majorly on imports, so essentially Europe and parts of Asia. And the attractive countries at the bottom right are predominantly from the Middle East, so Iran, Qatar, Saudi Arabia, North America, Canada, and USA, and the CIS countries such as Russia and Uzbekistan. And places like Egypt, Argentina, Malaysia, Trinidad, and Tobago could also have been considered second-tier investment opportunities in 2018. However, if we jump forward 7 years to 2025, you'll see we've added our seven potential feedstock markets, so more flags to learn. But here the central theme generally remains the same. However, there have been some telling movements, particularly for individual countries. For instance, you can see I mentioned Pakistan and Bangladesh in the previous slide. Here, unlike in 2018, they've actually got higher prices, and this is the impact of imports. So now they join the list of countries where they have poor supply prospects and high prices. So bad news for investing in Pakistan and Bangladesh. Out of the 7 new markets we looked at, 4, Mozambique, Tanzania, Turkmenistan, and Iraq, can all be considered attractive to investors in 2025. And all the previous countries that were in that box, apart from Algeria, stay there. So, and also, seeing as prices have gone up, the median price is now 4.75 MMBTU, dollars per MMBTU. Trinidad and Tobago, Argentina managed to sneak into the Goldilocks box. So if we jump a further 10 years, we're now in 2035. Again, the median price has increased, and so we're now at 6.47 MMBTU, dollars per MMBTU. And here, supply issues towards the end of the forecast period have taken their toll on places like Trinidad and Tobago and Iraq, who are now much less attractive than they were in 2025 as an investment opportunity. However, Mexico joins the list of attractive opportunities. Egypt and India also continue to experience supply issues, and which pushes them to the left. Nevertheless, the overall material picture doesn't really change from 2025, with the same countries with big supply prospects and relatively cheap gas remaining the most attractive options. So a summary of the key findings is that the consistently competitive countries are those found in the CIS, such as Russia and Uzbekistan and Turkmenistan. The North America, Canada and USA are also very strong, as well as the Middle Eastern countries such as Qatar, Saudi Arabia, Iran and Oman. In terms of potential new markets, Tanzania and Mozambique are also very, very competitive. Consistently, the less attractive options would be in Europe and other countries such as China and Bangladesh, which score poorly because even though they've got increasing demand, increasing production, the exponential growth in the demand in these regions overshadows this. However, I can't stress this point enough, is that all analyses of this type need to be framed from a pragmatic point of view that acknowledges the hard to predict and the non-empirical variables. To demonstrate this, I'm going to discuss 2 examples, Venezuela and Egypt. Now, you may have noticed that I didn't mention Venezuela at all, even though it appeared in that sort of perfect zone in all 3 scenarios. And here, we have a situation where we have a country with large reserves of natural gas and established infrastructure. So in theory, it should be a perfect place to invest, and low prices as well, obviously. However, due to the prevailing political climate, there's less impetus to sort of extract this gas. And so from our perspective, this is actually a supply poor area, and we would then discount it from this analysis. However, this can only be done when looking at the results and actually putting some common sense on top of the empirical evidence. If we move to Egypt, Egypt is like other countries in the Middle East and North African region like to regulate their feedstock pricing, heavily subsidize fuels, and Egypt was an example that even when they were importing expensive LNG, they were still subsidizing fuels. Come along a revolution, 2014, LCC comes to power, and since then, prices have been going up and up for gas. And this is even with new findings in and around the Egyptian sort of territory. So you can never predict how regulated feedstock prices will sort of do in the future. A regime change can completely upend that. So it's very important to also take that into account. And it's very hard to predict this as well. Another variable that should be considered is oil price. We all know how variable and volatile oil prices can be. So I guess here the important point is to ask ourselves, this study was done on the basis of $80 per barrel going forward, so a fairly strong oil price. And so the important point is to ask ourselves, would lower oil prices affect the 35 existing potential feedstock markets differently in terms of cash cost? Well, principally we'd expect those areas with higher gas costs and gas prices that are linked to oil to definitely feel the change. And these countries would be European countries, Brazil, China, and those beginning to import LNG such as Malaysia, Thailand, and Indonesia. North America, we would expect as well to experience some downward pressure on prices, and this is more from an arbitrage perspective, particularly with prices in Europe. However, the lower cost Middle Eastern markets I mentioned that regulate their prices would probably not even feel anything in terms of, and they're kind of immune to the volatility in oil prices. So overall, we don't think actually the relative material ranking would change much based on the changing in oil price within reason. Now, if you'll let me go off on a little tangent before I finish and summarize, one of the fun things I like to do with our model is to test different scenarios and different sensitivities. So I thought for this presentation, I would prepare an analysis, the same analysis, but investigating a completely deregulated, uncontracted free market. Essentially, all gas is spot volumes. So what do we get? Prices shoot up, and this is a snapshot of 2035, the last graph you saw. Immediately prices go up for most countries, and so the mean is now $7.22 per MMBTU. But interesting, some countries like Oman, Iran, and Iraq experience lower prices, which basically says that these countries are regulating their prices above market rates. However, the prevailing result is that prices that are regulated, such as in Saudi Arabia and Qatar, they go up because they're being regulated at a discount to market rates. But another interesting point to sort of take from this is, if you look at the top band right at the top half, all the importing countries seem to have begun to converge in price, whereas before they were all disparate and spread out. Here you can see a definite distinction between the exporters to the bottom right, and then all the importers just spread across a very narrow price range. And this is to be expected once you accept that gas is becoming an increasingly commoditized material. So to finish off, I'd like to talk a bit more about the complementary sort of analyses I mentioned at the start. One way that we can translate these findings into competitiveness is using the way that they're delivered into key markets. And this actually brings more dimensions to it, so we start to look at variables such as freight and taxes, perhaps, and seeing how this affects competitiveness of a plant. Now, this is just an example from a scenario that we did in 2016, so it's not the most recent data, but I just wanted to use it as an example of further analysis and what we would go on to do after we've taken our initial analysis. I guess the point here, the main point to look at here is that Uzbekistan and Turkmenistan, very competitive until you bring in the uncertainty of the fact that they're landlocked, and therefore land freight can be substantial. So it's also very important to not just accept the previous analysis, but to also think about the other aspects and pertinent factors towards making a plant competitive. So to conclude, global gas supply is becoming more available and freely traded, essentially due to LNG, but also by pipeline gas in regions that are connected. The general trend is for gas prices to increase over time, be this through rising cost of supply in traded markets, linkages to oil price, more costly and difficult supply in big exporting countries, and the removal of subsidies due to budgetary concerns. The CIS countries with abundant domestic natural gas resources perform really well as lucrative destinations for C1 chemical plants, in particularly Russia. With that being said, freight considerations have to be considered because they can be considerable, particularly for landlocked countries. The Middle East, Qatar, Saudi Arabia, Iran and Oman, North America, USA and Canada, and Tanzania and Mozambique also would be competing for the same investment projects because they have shown themselves to have security of supply and relatively cheap gas. And thank you very much for listening. Well, I guess we're doing questions and answers after that.
Да, спасибо большое, Пауло, за подробный, интересный backlog.